The IRS just dropped its inflation adjustments for 2026, and if you're retired or getting close to retirement, these numbers matter a lot more than most people realize. Every year, the IRS adjusts tax brackets, standard deductions, and a handful of other figures to account for inflation. But 2026 is not just another routine adjustment year. There are forces converging in 2026 that make this particular set of changes uniquely important for anyone living on a fixed income, drawing Social Security, taking required minimum distributions, or planning Roth conversions. So let's walk through all of it. The actual numbers, what they mean in plain English, and what you should be doing right now to take advantage of them before the window closes. Let's start with the most fundamental piece, the tax brackets themselves. For 2026, the IRS has widened the brackets to account for inflation, which is actually good news for retirees. Here's how the brackets shake out for single filers. The 10% bracket now covers taxable income from $0 up to $12,100. The 12% bracket picks up from $12,101 all the way up to $46,150. The 22% bracket runs from $46,151 to $98,350. Then the 24% bracket covers $98,351 to $182,050. After that, you're looking at the 32% bracket from $182,051 to $231,350, and the 35% bracket from there up to $578,125. Anything above that is taxed at 37%. For married couples filing jointly, you essentially double most of those thresholds. The 10% bracket goes up to $24,200, the 12% bracket stretches to $92,300, and the 22% bracket reaches $196,700. What this means practically is that if your income stayed the same from 2025 to 2026, a slightly larger portion of it now falls into lower brackets. It's a modest but real benefit, especially for retirees trying to manage income carefully. Now the standard deduction. This is the figure that most retirees use instead of itemizing, and the IRS raised it again for 2026. Single filers get a standard deduction of $15,150, up from $15,000 in 2025. Married filing jointly gets $31,500, up from $30,000. But here's the piece that many people overlook. If you are 65 or older, you get an additional standard deduction on top of that base amount. For 2026, that additional amount is $2,000 for single filers and $1,600 per qualifying spouse for married couples. So, a single retiree age 65 or older can deduct $17,750 before a single dollar of their income is taxed. A married couple where both spouses are 65 or older can deduct $34,700. That is a significant shield against taxation, and it's one of the most underappreciated benefits available to retirees in the entire tax code. One of the biggest issues retirees face every year is figuring out how much of their Social Security is taxable. And the frustrating reality is that the thresholds used to calculate Social Security taxation have not been adjusted for inflation since they were written into law back in 1983. So even though tax brackets and standard deductions go up every year, the Social Security thresholds stay frozen. For single filers, if your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security, exceeds $25,000, up to 50% of your Social Security becomes taxable. If it exceeds $34,000, up to 85% becomes taxable. For married couples, those thresholds are $32,000 and $44,000. Because these numbers never move while everything else grows, more and more retirees get pulled into Social Security taxation every single year. This is often called bracket creep, and it's a slow, quiet tax increase that nobody ever votes on. Understanding this dynamic is absolutely essential to planning your retirement income correctly, because a small Roth conversion or a slightly larger RMD can push you across those thresholds and trigger taxes on income you previously thought was protected. Speaking of required minimum distributions, the 2026 RMD rules follow the Secure 2.0 Act changes that raised the starting age to 73, with a further increase to 75 coming in 2033. If you turned 73 in 2025 or are turning 73 in 2026, your first or second RMD is due this year, and you need to factor that distribution into your total income picture before it happens, not after. RMDs are calculated by dividing your account balance as of December 31st of the prior year by a life expectancy factor from the IRS Uniform Lifetime Table. What makes RMDs so dangerous from a tax planning perspective is that they are mandatory. You can't skip them, delay them again after your first year, or control their size the way you can with other income sources. When a large RMD lands on top of Social Security, pension income, and any interest or dividends you're receiving, it can very quickly push your taxable income into a higher bracket, make more of your Social Security taxable, and even trigger IRMA, which is the Medicare premium surcharge that kicks in when your income exceeds certain thresholds. IRMA deserves its own spotlight here because it catches so many retirees completely off guard. IRMA stands for Income-Related Monthly Adjustment Amount, and it's an additional premium that higher-income Medicare beneficiaries pay on top of their standard Part B and Part D premiums. For 2026, the standard Medicare Part B premium is expected to be around $185 per month, but once your income exceeds $106,000 as a single filer or $212,000 as a married couple, that premium jumps significantly. At the highest income tier, a single person could be paying over $560 per month just for Part B. And the critical thing to understand is that IRMA is based on your income from 2 years prior. So your 2026 Medicare premiums are based on your 2024 tax return. If you had a one-time income spike in 2024, maybe you sold property, did a large Roth conversion, or had a big RMD, you could be paying elevated Medicare premiums right now, even if your 2025 and 2026 income is much lower. You can appeal IRMA through the Social Security Administration if you've had a qualifying life event, and many retirees don't know that option exists. Now let's talk about what all of this means for Roth conversion strategy, because the updated 2026 brackets create a legitimate planning opportunity. The 12% bracket for married filers now extends all the way to $92,300 in taxable income. The 22% bracket goes up to $196,700. If your current taxable income, after subtracting your standard deduction, is sitting in the lower end of those brackets, there is room to convert traditional IRA money to a Roth IRA and pay tax at your current rate, rather than a higher rate later. Watch this space closely, because if those cuts expire, the 22% bracket could revert to 25%, and the 24% bracket could jump to 28%. Converting now while rates may still be favorable could save tens of thousands of dollars over the course of a retirement. One more item worth mentioning is the gift tax exclusion for 2026. The annual gift tax exclusion has been raised to $19,000 per recipient. This matters for retirees who are thinking about estate planning and transferring wealth to children or grandchildren. You can give up to $19,000 to as many individuals as you want, without filing a gift tax return or eating into your lifetime exemption. For married couples, that means $38,000 per recipient per year in completely tax-free transfers. The lifetime exemption itself remains elevated at over $13 million per person through 2025. But again, if the TCJA sunsets, that number gets cut roughly in half starting in 2026. So there is a real and time-sensitive argument for accelerating estate planning conversations right now before those changes potentially hit. The bottom line is this. The 2026 tax brackets, the higher standard deduction, the additional deduction for those over 65, the unchanged Social Security taxation thresholds, the RMD rules, the IRMA tiers, and the potential expiration of current tax rates are not separate issues. They are all interconnected pieces of a single retirement income puzzle. Retirees who understand how these pieces fit together and who do their planning proactively rather than reactively consistently end up keeping more of their money than those who simply take distributions and file taxes without a strategy. Work with a fee-only financial advisor or a CPA who specializes in retirement income if you haven't already reviewed your situation in light of these changes. The numbers are new, but the opportunity to act on them is right now.